it's going to be a gap up start. That's, I think, is evident. But the point is, where do you go from there? Are we likely to bounce from and recover from yesterday's selling, because FI selling was quite intense? It's a 1% uptick for the Bank Nifty. It's a good market breadth to start the day with. It's a decent day in terms of where the market opening rates are. Metals are bouncing back, IT is bouncing back, banks are also bouncing back. This is happening despite the fact that last night copper and metal prices, they came off. I want to start with Vedanta, because that for me, I think, is the newsmaker. That's where the promoter has reversed the pledge positions, but it's not really having a rara impact on the stock per se. 284 rupees for Vedanta. Maruti, the promoter in this case, which is Suzuki, they've increased their stake marginally, but just endorsement of some kind of a confidence, 155 rupees higher than. Adani Group stocks yesterday were on the butcher block, especially Adani Enterprises and Adani Ports. They're bouncing back, and they're bouncing back very smartly. It's almost 1800 rupees now for Adani Enterprises. From 4000 to 1000 and 1000 to about 1800. What a yo-yo it's been for Adani Group of stocks. But the breadth, I think, is the meaningful point for me. The small cap index is also a meaningful point. So we are definitely seeing renewed vigor in the market. Will it sustain? Because 17,200 now is clearly flashing on the screen.
Yeah, just looking at a couple of other names and what really is happening with some of the news-based entities, how are they performing in trade? While for the index, we are pretty much in line with what the SGX Nifty was indicating. And it seems like it's a stable start, but who knows where the markets go from here. Reliance, let's see what that heavyweight is up to. Jio has now launched postpaid family plans called Jio Plus, starting at $399, holding higher by nearly about 1% for Reliance, almost nudging that 2,300 rupee per share price point. LTI Mindtree, they held an analyst call, and they're saying that revenue synergies are seen at about $1 billion. And it's a 19 to 20% margin that they see by FY27. LTI Mindtree holding out quite smartly in trade as we speak right now. Maruti Suzuki has bought about 3.5 lakh shares via the open market. They've increased the stake now to 56.48%. Maruti holds up about almost 2% in trade right now. And PVR, very solid commentary coming in from their management meet, or analyst meet rather, and this is the first, remember, after the final approval that came by for both PVR as well as Inox merger. PVR was a big winner yesterday. Today also it's holding out. PVR now plans to add 200 screens per year. The focus is going to be on platform integration with Inox. PVR holding up almost 2% as we speak. RailTel, another order coming in their way. PNC Infra, lowest bidder for one of the NHAI projects. And then GMR Airports is going to be meeting soon to consider fundraising. These are a couple of stocks which are in focus. Crude, by the way, has extended its decline. I bet that's not auguring well for the sentiment on both ONGC as well as Oil India. Remember, crude, or rather Brent, is now almost around that $78 per barrel mark. ONGC a little bit soft in trade, as is the case with Oil India. But for the index, Nikunj, a little bit of a relief.
Well, a little bit of a relief, good start. The breath is looking strong, and I really hope that today it's a good day of trade. Looking at the initial rates, there is reason to remain charged up. Right, Shankar Sharma is ready. Shankar, should I start with good morning, good afternoon, or good evening? Because I don't know which geography you're joining us from. Sometimes it's Dubai, sometimes it's India, and sometimes places which I can discuss on TV.
What?
That's correct. Yeah, so I think it's still morning in Dubai.
All right, so joining us from Mumbai. Dubai, right?
Yeah,
Dubai, yes.
Okay. Unusual choice of t-shirt. Either has to be red or green, but yellow means that not here, not there. Is that kind of a market we are in? Not here, not there?
Yeah, you can call it the midpoint. So it's a very boring sideways market. I mean, it might look exciting because it's been down from the peaks a bit, but it's been a very slow grinding fall most of the time. So yeah, it's been quiet, and I think quiet is good. I mean, there's no reason to come to market for excitement.
Shankar, the big question which perhaps everybody wants to understand from you, and you're someone I distinctly remember, was one of the first market market observer who came out in 2008, said that, look, there is a problem in the world, sell everything and get out. Given what's happened to SVP, parallels have been drawn between 2008 and 2023. Is there similarity, or this is just a fiction of imagination?
So 2008 was the first time we saw a banking crisis in living memory of that order. I mean, there can be routine failures in India too. In 2000, Global Trust Bank failed. In I think 90s, also a couple of banks failed. Those are individual events, and in the US, there have been a lot of bank failures. You know, there are community banks. US is a huge country like India. There are small banks serving a local community. They keep going bust if you look at the data. But 2008 was a complete different animal in which there's a large scale collapse of the financial system itself, not just lending banks, but investment banks and brokers and everything. So right, everything from Merrill Lynch to Lehman to Washington Mutual to AIG, which was an insurance company. So it was a completely different order of magnitude. This is compared to that, we would take this any day, the SVP or the Signature Bank collapse. The other thing is regulators learn to act very quickly. There is always learning in with a new event. So 2008 will not get repeated by any stretch. I mean, let's not even start thinking like that.
So can I safely say, Shankar, that from an Indian stock market investor, this is passe now. The storm has come and gone. This is not like tip of the iceberg, which will have a snowball effect.
I completely agree with that. I don't think SVB is the problem. If you indeed you want to look for problems, the problems may well be more internal to India than an external shock like a large-scale banking contagion in the US. I mean, that will have its occasional day in the sun, but that's not the reason why India has underperformed this year. I mean, that's a complete different set of reasons altogether.
Bigger problem for Indian markets in a sense this year has been what's happened to the Adani group of stocks. Now that deleveraging has started, the promoter has released their own pledges. There's a big white knight who's come and invested $2 billion in Adani group of stocks. Do you think from a market standpoint also, is it time to move on?
I think Adani was a non-issue for any serious investor in the stock markets. I mean, we made it an issue beyond what it deserved to be. It's a large group, but still one group, and one group cannot be said to be representative of the entire market, no matter which group that is. I mean, we've had governance problems with Infosys. We've had governance problems with Reliance. I mean, and not one, but I mean, I think maybe a dozen of them. SEBI has passed orders against Reliance promoters, against Mukesh Ambani or against Reliance company or group companies. Sun Pharma, marquee company, has had series of problems in the last 3-4 years' time. None of that has been represented in the public eye as if that is going to dent the image of India or it's an attack on India. I mean, that's all complete and total nonsense. This is a group problem. The group is dealing with it, and more power to them. They are important for the growth of certain parts of India, which is the infrastructure part. And I hope and I pray that they come out of it. But to extend that to say the market is going to suffer because of that is, I mean, that is a complete non sequitur in my view. Again, I say these are all, we draw false positives and false correlations and causalities. Adani Group or SBB was not the reason why the Indian markets have been somnolent in the last 2 or 3 months' time. The reasons are more internal. The reasons are that there is a slowdown in the economy based on the GDP numbers that we have seen. The markets have been sensing that. And I speak to companies all the time. And right after Diwali, from Diwali onwards last year, I started to get a sense that there was a slowdown in spending. Rural has been hurting in any case. It was urban spending which was propping it up, and that's also started to slow down. So that is where the market started to get a bit jittery about numbers, corporate growth, corporate earnings growth. It's not Adani, it's not a foreign bank contagion.
Shankar, just taking a leaf off from your latest tweet, saying that some of the yields available in fixed income and financials in the US are looking simply mouth-watering. Do you think the fact that fixed income is giving you more, better or more assured returns than equities is going to make the attractiveness of equities as an asset class, shrink in the near term?
You're 100%. I am assuming that's Aisha. Okay, wait.
Yes.
Yes, hi, sorry. The screen was minimized. Right, yes. Hi, Aisha, morning. You're absolutely spot on. I think that is the competition for the market, is the fixed income part. It's much detested cousin, because all of us are equity guys. We don't like fixed income in most part, but it is providing in India and globally some amazing, returns. I mean, in the US, like I tweeted, you can buy good quality bond ETFs for now for about 5%, 5.5%, 6% yields, even 7% yields. Real estate investment trusts are like 9%, 10%, 11%, 12% yields. In Singapore REITs, you can get, fairly decent yields. So in India, the yields are really mouth-watering, to say the least, which provide you low volatility returns for an average investor. So it is, again, that is a good reason to attribute for the equity markets underperformance in India. Adani or the foreign bank thing are all just very temporary phenomena. It's more fundamental, which is that rates are very attractive and people are at this point choosing rates fixed income over equities. And again, I go back to my point that the economy being what it is, my belief is you're not going to get a broad bull market. I don't think any of us should hold out hope that we are going to see a broad bull market in India, that is, anytime soon. We are going to see very patchy markets in which a reasonable part of the markets will be flat or even down, while small pockets of stocks, whether in the Nifty or below the Nifty, will be doing well. And that's really the skill of your investment acumen will be tested in this year.
Hi there, morning. So in light of that, what do you believe investors should be doing, or where is it, do you believe, that will be some of those small patches of outperformance or good performance? Would you say one can look at themes like for instance, the private banks, the CapEx theme, defense as a space?
None of the ones that you mentioned I like, because, all of them are private banks or banks in general, I don't like. I've not liked them for a very long time, save for maybe 2 or 3 of them. They have their occasional moments, but by and large, it's a problematic industry because of the basic structure of the business itself. And that's exactly, by the way, what happened in the Silicon Valley Bank. That while they had problems on the balance sheet because they were exposed more, obviously everybody was exposed to low interest bearing bonds. And when they rose, they had to market, and we know all the story. But the reality is that all banks are like that you have, your investment book in these kinds of securities, which have big interest rate risk. And sometimes you hedge them. Sometimes you want to play the game of not hedging and capturing the unhedged returns. That's all treasury management, which sometimes can go awry, which it went in the case of Silicon Valley Bank. But the larger problem is this: any bank which faces large-scale withdrawals will go under. Any bank. It could be ICICI Bank, it could be any bank. And we saw 2008 being a moderate run on ICICI Bank when Mr. Kamath had to come out and assure investors and depositors on television several times. So any bank can go under because no bank keeps enough cash to satisfy all deposit holders. And Silicon Valley Bank was a particular example of a very narrow set of depositors. But I'm saying banking is a problematic one. In the economic environment I see for India, I'm not going to go out and risk my money on leveraged companies, whether they're banks or not. So the opportunities still lie in the small cap space. I mean, again, I am a big votary of that space. I'm sure it's no surprise to any of you. But I continue to remain hugely optimistic and bullish on the outcome and outlook for small caps. I mean, there are any number of good companies, again, very reasonable valuations. And they have not actually fallen much in this correction also, which again tells you that the tape is very, very favorable to small caps.
I know, Shankar, you're not going to give us names, but at least give us the themes that look attractive within small caps, as diverse the universe is.
Okay, Aisha, I'll give you one name without the name, okay? But that'll help you because all of us are aging and we need collagen, right? It's good for the hair, skin, bones, everything. So there is this company I discovered last year. It's up 100%, which is not a lot. I think it can go a lot higher. And, still very undemanding valuations. Fantastic numbers, great ROE. And again, I think a teen kind of multiple. So there are, if you work hard, and I've been working hard on this by having meetings on Sundays with companies, let alone on the weekdays. because out of this rubble, again, which we are seeing in the market, exactly the same thing, the same movie was played last year in March, exactly around the same time when the Russia-Ukraine war erupted. The market sold off. It was a fairly brutal sell-off, as you all may remember, right up until I think May and June. And in that period, I built a portfolio, a new portfolio, apart from whatever else I held, which I was looking at just in the last couple of weeks. I mean, the performance has been fantastic. I mean, they are up on the average 100, 150% from last May or June up until now. And I think we are entering a similar phase when we pick wisely and then we sit and relax and, enjoy life. I mean, we go off-roading, we go biking, and we do whatever you want to do. So this is that period. Exactly the same time last year was that period too. So utilize this period instead of despair. Be positive. You will find fantastic bargains. Build another portfolio two, which will help you, through the next 1 year at least, as it.
It's actually not too. It's actually not too far away from its 52-week low as well. 214 thereabouts is where the stock is. I did my research on what stock that is actually. We will try and flash that on your screen. Nikunj, you had some question.
No, I'm just trying to.
On collagen.
Well, not at that phase of my life right now, but yes, as India grows old, all of us perhaps scientifically it makes sense to use it. You've done some research on it already, is it?
Yeah, I mean, I just searched which stock he's talking about.
Not collagen, but the stock.
That picked up, yeah, not collagen, not yet.
Okay. Which one did you get?
Titan Biotech, right?
No.
Oh, okay.
I will tell you offline. Okay.
Okay.
Shankar, a lot of our viewers may not have the ability or they may not have the understanding of buying into small cap stocks or even mid cap stocks. What should they do in this kind of a market? For those who say, look, I want to buy few outperforming names where a 50% upside in 3 years or a 100% upside in 5 years is something I'm satisfied with.
50% upside in 3 years you're satisfied with. I think that's Nikunj, I don't know which planet you're talking about. If you
I'm
make
being
that,
reasonable here.
I'll be a very happy man.
I'm keeping expectations low. Like they say, no, umeed kam rakho, khushi zyada hogi.
Yeah,
Anything you get more than that is bonus.
50% in 3 years is 50% in 3 years. अगर उम्मीद कम है boss, तो I don't know. or optimism किसको कहते हैं. But be that way, I think for investors, again, I keep going back to the thing, asset allocation. Don't get too exposed to equities. Despite all the last 3 years euphoria around it, equities are a difficult place to make money. And take it from me, I've done this for a very long time. And anybody who is honest will tell you that there are periods in which it's very easy when we just show up and we make money. But for larger periods, it can be a problematic period in which nothing happens or bad things happen. And we are in a period where maybe nothing happens, which is substantial. In which case, your fixed income part really helps you. And it's not an enemy, it's your friend. Treat that as a friend in your home. Give it due respect. In my view, all those assets for Indians, I tweeted this as well, that a huge exposure to real estate, gold, and fixed income is what keeps India's consumption story alive. And I hope and I pray that unlike the West, we don't become a country with 60-70% equity ownership. That would be disastrous because the volatility of equities is high. We know that. And that directly affects consumption in the Western world. We don't want that happening in India. Gold, I mean, has been fantastic in the last, 6-8 months' time. And that again is going to give you, prop up the consumption. Real estate has been very strong. I hear it from real estate companies. Fixed income numbers are very good. So India, an Indian investor or householder is a very smart asset allocator. Don't change that. Don't become equity centric so much that this volatility kills you. So on your 20-30% equity exposure, which is the highest I would recommend, for an average person on the street, I don't think there is any other option but to go to a fund manager and give you money. And again, there are ways to choose that. But if you're a self-directed investor, and I said this, I think last year as well on your shows, that you can easily run screeners and, there are a lot of tools available for an averagely good investor to do as much as a professional investor might be able to do without being able to talk directly to management. Leave that aside. Other than that, all the tools are there. Work hard in this bear market. I remember I worked very hard. The hardest I worked in the last 12 months was in the period of May and June. The rest of the year was a piece of cake despite all the volatility. So it's the same principle from my experience to the guy watching this, guy or girls watching this. Uh, Spend time if you're a self-directed investor. Run screeners. Look at good quality companies in this phase. Build a 25 stock portfolio, and I think you'll be laughing all the way to the bank. Hopefully, a solvent bank in the next 12 months' time.
Well, thank you very much and enjoy your rest of the day. And thank you for waking up early in the morning. I know it's not your routine habit to get up early in the morning and that to join a television interview. So thank you very much for that.
Thanks for having me, guys. Bye.
What do we have? We've got a market which is so far looking steady. Now that's the good news, that we've not caved in or we've not collapsed, but it's only 20 minutes, still rest of the day. I really hope that we are not in a repeat of what we saw yesterday, that a good start and it translated into a poor close. But you've had 4 days of selling, so technically things are looking oversold, and a bounce or a dinky bounce certainly cannot be ruled out. Jitendra, Quality Director Investment Management with Credit Suisse Wealth Management, joins us now. Jitendra, good morning. Thank you for joining us. What is the buzzword amongst private clients right now? How are you telling your clients to navigate this kind of volatility?
Hi, Nikunj. Yeah, so pretty challenging time. Volatility is extremely high. Nervousness is there. So I'm having several meetings with our ultra high net worth individuals, and they have seen these kind of volatilities in the past. So as an asset allocator, our job is to direct our investors towards their proper asset allocation depending on their risk appetite and their objectives. So net, our investment committee believes that equity is a difficult asset class, at least in the near term. We are underweight on developed market equities. However, we are little positive on Asia relative to the developed markets. And this is what we are communicating. For little bit risk averse investors, we are overweight on bond portfolios. We think yields are attractive in India. But from a medium to long term perspective, we are extremely positive on Indian equity markets. We think that it's going to be in a sweet spot. We have been very vocal that India may command very high valuations and it may remain a very highly valued market. So from next 3 to 5 year perspective, if anyone has patience and investment horizon, I think equity looks a very differentiated and a very attractive asset class. So we are communicating our investors that look, first half of 2023 is going to be year of consolidation or some kind of correction as the valuation froth settles. However, from H2 onwards, we expect a good recovery in Indian equity market. So use this correction as a buying opportunity, certain sectors, certain stocks which are there for long term, and you will make money.
Why do you think second half will be better than first half?
Yes.
No, why do you
So
think?
see, there are two things to it. First is that right now it is extremely difficult to predict what Fed is going to do, looking at the inflation, looking at geopolitical situations. We are also seeing valuation is little bit higher side. So I think after this consolidation, as we move towards, let's say, post June 2023, there's a high probability that we may get more clarity in terms of the Fed tightening cycle. We were of the opinion that this is not a kind of 2002 to 2007 like scenario where Fed is going to tighten and equity markets will also do well. We expected that such a sharp tightening by the Fed may lead to some kind of correction or reset of growth projections, and that is largely now I think it's into price. We are also looking at inflation should starts to fall a bit in the second half because the base effect is going to catch up. So I think from a rate perspective, we are almost peaking. So I think that from second half onwards, there will be more clarity in terms of 2024 and 25, where we think that there are a better chance of rate cuts. Secondly, we also have elections in 2024. So second half, we might start to see some more action in terms of taking exposure to Indian equities. Largely, the risk premium of India, I would say that the political risk premium for India has fallen. And if we have another 5-year term government, a very stable government, then I think we might see more inflows in equities in the second half in that anticipation. So we think that yes, first half is going to be challenging because of valuations, because of Fed tightening, but second half these headwinds should start to abate as the base catches up.
Jitendra, hi, morning. So in light of what you're saying, do you think that there's any worry right now when it comes to the overall banking sector? It seems like most of the experts on the street have said that the Silicon Valley bank crisis is unlikely to really have a contagion effect on Indian banks as a whole. What would be your outlook on the banking space?
Hi. So I think yes, this is little concerning that what is happening in US, but we are also of the opinion that Asian banks are in a better position. In fact, Indian banks have better, tier one ratios, uh, and I think we are pretty much insulated from what is happening in US right now. However, one has to look at earlier, or I would say that pre-COVID levels, there were little opportunities. People were just looking at private banks. Some of the PSU banks, smaller banks were extremely struggling. But over a period of time, we have seen that banking system has cleaned up their books. So the opportunity is huge, and we are spoiled for choice. In fact, in the banking space, and hence overall sector-wise, if I look at the banking index, is cheap. It's not very expensive. But still, I don't think that the large banks, top 2, 3 banks, are going to command even higher valuation compared to this pre-COVID levels because there is a lot of opportunity available as some of the smaller mid-tier banks have actually done really a good job in terms of curtailing their NPAs and their risk management practices. So overall, we remain overweight on the banking sector with a very good selection and a diversified holdings. However, in the near term, we have cut our exposure in the PSU space. We have booked profit in PSUs and moved on with large private banks, as we think that liability franchise, the strength of the liability franchise is going to be key in the next 1 year or so. So we are rotating our portfolios within the banking sector, but overall we remain overweight in our portfolio context.
Let's understand a very basic scenario. Fixed income gives you 8% return and with a promise to lock in for a long period of time. The projected returns from equities will not be more than 11 to 12% as per most of the research reports I've read, which comes with volatility and which comes with a risk. With fixed income, there is a bit of a guarantee and there is no volatility. Why should one go for equities and when the projected returns are not more than 50% higher than fixed income?
So Nikunj, it's a matter of asset allocation, and so if I have to look at next 5 years or so, then definitely equity will outperform debt market, as we think that the projected returns for Indian equities is actually going to be solid. Uh, Looking at the kind of nominal GDP growth for India, which is going to accelerate. So, for example, see, we think that India is coming out to be a good wealth creating market. Even if I look at since 2000, so I will give you example that India's, let's say, per capita income grew by almost 6 times, while China's per capita income grew by 13 times. But India has outperformed, China in the local as well as in the USD terms, right? So Indian market is actually a wealth creating market. So you should not be perturbed by so much of this volatility because that part and parcel of equity investment. But if you are a long-term investor, definitely equity as an asset class will outperform bonds. And I feel that this is what one should look at. Secondly, India is in a sweet spot with respect to the GDP growth, with respect to the equity market, with respect to flows. For example, if we grow 10% in the next 3 years continuously, currently India's economy is around 270 lakh crore. And if we grow 10% in the next 3 years, we are going to add almost 100 lakh crore to India's GDP, which is one third of what we added over the past 75 years of independence. So we are in a sweet spot for sure. And to play this, we need to be invested in a risky asset class such as equity investment. And whenever the large correction comes, and if you are investor during that time, the overall return could be even higher than what you have mentioned recently, 10 to 11%. But we think that there could be even better return opportunities if you invest during the time of the sell-offs or time of the kind of panic that we see generally. So from a valuation perspective, it is extremely important when you enter in the equity market. And definitely when the correction comes and if you are invested at that time, I think over the next 3-5 years, there's a double-digit kind of returns, which is pretty attractive.
All right, Jitendra, thank you for taking time out and joining in, giving us a view as to how one should be navigating the volatility, what the risks are for the markets, as well as your long-term outlook for Indian equities. Tell you what, we'll take a very quick break right here on the show. Stay with us. We continue to assess the markets and what your outlook should be with Vikas Khemani of Carnelian Capital Advisors in just a bit.
Vikas Khemani joined just now. Let's connect with him to understand that what should one do, how should one read into the current global turmoil, if I may use the word. Vikas, good morning. Thank you for joining us. A lot of parallels have been drawn that this is not like 2008 exactly, but this is similar to in terms of the collateral damage it eventually will have on asset prices. Do you think we are in repeat of not the same magnitude, but a little bit of the same because of the because of the problem in US banks?
Hi, Nikunj. Good morning. See, we all know that while a lot of things remain the same, and yet there are some things are different in every sort of incident and cycle. Of course, global financial crisis happened because of the excesses in the banking system, especially on the levers front, which I think is different than this time because this time around there is not a lot of leverage in the system. Of course, banking by design is supposed to lend and take the money from the depositors. This time around, it is about the losses, mark-to-market losses sitting on the books of the balance sheet. And larger banks are still, well managed or reasonably solid as it appears from till now. I mean, unless some surprise is waiting. But looks like that leverage this time around in the banking system is far, far lower than what it was in 2008 crisis. And another thing is that right now, with a smaller event, the regulators and government has come into action to kind of rescue these banks and reduce the contagion impact of this on a wider economy. So I'm assuming that unlikely that it will have a wider impact, but you can't wish away the pain when the interest rates are raised so sharply in such a short period of time. The pain is bound to happen. It is bound to reflect in some way or other. I mean, still we might have some pains coming in the pension funds and endowment funds because they also are sitting on large amount of mark-to-market losses. The only thing is that since they don't have a liability immediately staring on you, it can continue for long. So while one knows that there's a hole there, but one does not know how whether it will come or how it will come. So I think these are very complex interlinkages. But from the outside, it looks like that unlikely it will, given the fact that everybody around is in action to make sure that there's no contagion. It should be contained according to me here. But we'll have to keep watching, keep evolving in the situation.
Let me look at a recent example. When there was the panic in Adani group of stocks, lenders also fell. In hindsight, if you bought the lenders to the Adani group of stocks, Adani group of companies today, that turned out to be a good, solid financial decision. So 3 months from now, 2 months from now, when we will look back and analyze March of 2023, and for those who bought because of the global SVP fear, will they be rewarded for their prudence?
So it was very, very wise point you made. See, whatever is happening elsewhere in the world right now, good part is that there's no economic impact or there's very minor or almost negligible economic impact happening on India as an economy. Our interlinkages on that part of the world is very limited, only to the extent, I mean, we don't borrow significant amount of capital from them. I mean, whatever money is coming in form of equity. So there's very limited linkages with the financial markets of US and India to that extent, or banking system of US and India. So I don't see any reason why Indian economy will get impacted with whatever is happening in the rest of the world. And to that extent, I completely agree with you that any such corrections, are seen or should be seen as an opportunity to invest. And in 6 months, whether it is 3 months, 6 months, nobody knows. But definitely, these are very attractive points. India's story continues to remain. In fact, our interest rates are not in a dangerous territory. In fact, as inflation settles down, which I think is a matter of time, whether it is 3 months or 4 months, I think we have already seen the peak, and slowly you will start seeing only coming down. There could be case made for Indian interest rates coming down. Whether it is again 6 months, 12 months, I don't know. But Indian economy is on a solid path. And slow down of 1 or 2 quarters always happens, but generally speaking, directionally, I don't see any reason, and hence any such price correction because of problem elsewhere. Just like you mentioned in case of Adani, if you can keep your emotions aside and know that the exposure towards of banks was against the collateralized assets in case of Adani, and people bought that. So same thing would happen, that our interlinkages of the Indian economy with US economy is limited. You can keep your emotions aside and buy that. So I completely agree with you on that point.
IT take a hit. Now, Persistent came out and said, look, we got a little exposure. We also heard from other IT companies where they've said that so far there is no problem in terms of a direct correlation with the SVP bank. But when you see a problem like this, the sector P multiples rarely expands. And on top of that, there is a US slowdown. On top of that, there is a layoff which is happening in the big tech funds. Do you think IT has peaked out for a long time now?
Not really. I think if you see, IT demand is only, if you ask me, getting better. Now, again, there are two perspectives to look at. One is the medium term to long term, or secondly, the short term, immediate term, right? I mean, whole of last year, everybody called out that IT demand will collapse, but we did not see that happening at all in the order wins of any of the large or mid, any company for that matter. We continue to see order book getting accreted better. Secondly, I think this time around IT spend is very discretionary. Yesterday, I think LTI Mindtree analyst meet also, they kind of alluded to similar things, that structural demand is very robust, right? Other thing which I think today, when somebody is giving an order to any IT company, he's doing only bare minimum what is essential for his survival, or operational purpose, right? The developmental expenditure on IT is yet to come, which in my opinion will start happening once the US economy stabilizes or interest rates starts coming down. So if you ask me, IT could be a very interesting play on interest rates coming down in US. Whether it happens 6 months, 12 months down the line, I don't know. And meanwhile, these companies are generating reasonably good amount of growth and cash flows. Now, these one or two clients going away, getting bankrupt, those events happen in every business, will continue to happen. But I don't see a reason why one should get significantly worried, especially when IT companies are delivering reasonably good growth and attrition rate coming down, helping them, right? I mean, whatever is firing happening in the new tech is helping IT companies to recover from the attrition which they faced, year and a half ago in a major way. So to that extent, it helps them.
But Vikas, I mean, truth be told, we're down a good 10%, right, from the top on the index. What as a strategy is it that you're doing in your funds at Carnelian? Have you been a buyer in the recent decline or the consolidation as well in the market previously?
So I think again we have to see it in the perspective. Please understand, markets are down only 10% of the peak. But in this period, what has happened? In this period, we have had such a sharpest rise in the interest rates. We have seen inflation shooting through the roof. Global situation completely changing. We just came out of a major, in the textbook, whatever you read, major shocks to the global economic growth. We are all seeing that. So in that context, also, if we are down only 10% of the peak, it, in my opinion, tells you a lot of resilience of the Indian economy, right? And it has outperformed most or all markets, across the board. So one is to look at on absolute basis, other is to look at what's happening elsewhere, because market operates in a relative scenario, right? Doesn't operate in isolation. So and these kind of corrections only do provide, like I was saying, that great opportunity, as long as you believe that Indian story continues to remain robust, Indian corporate earnings cycle is robust, Indian balance sheets are robust. And if you see, Indian balance sheets are fairly robust today. Our banking system, our household savings, household leverage. I mean, we are one of the most under leveraged country around the globe. So yet there are so many investment cycles just kicked in. Consumption cycle is not even started according to me. So we are in we as an economy has lot of drivers of growth, and whatever is happening rest of the world is in some sense subtly benefiting India. So I will say these are the corrections which are great opportunities to deploy capital, and that's what we've been doing. In fact, we are calling some of our clients saying that deploy money. If you want to deploy more money, this is the time. I mean, that's our view, and we continue to remain. We may be wrong in short term, I don't know, but I'm reasonably sure these periods, when you look at, like Nikunj was saying, year downline, 2 year downline, are great opportunities, and those prices won't probably come back.
Where, Vikas, are you telling them to deploy money then if you believe that there is this opportunity?
No, absolutely, absolutely.
Where is it, I'm asking, that you're telling them to
Okay.
deploy? Yeah.
Oh, sure, sure. Sorry. So I think clearly, in my opinion, banking will lead the rally even when it recovers from here, because that's a large sector. Sector is in great shape. It's growing well. Profits. I mean, if you look at credit growth has just picked up, and it just continues to generally, sort of remains robust for some time. So I think, at least I see next, you know, 18 to 24 months, this sector remaining pretty decent, and that would lead the rally. I'm quite optimistic and positive on the manufacturing story. We are seeing companies changing their scale, and that kind of uplift happening in many manufacturing spaces across the board. And one can look at companies, again, this is a very diversified way, but I think some of the great opportunities are there. Stock prices have corrected 40-50% in many cases, and those are very, very interesting opportunities, according to me, to have a look at it. IT, like I was saying, we continue to remain reasonably robust. Industrials, capital goods cycle again looks pretty decent. So I think India has a very wide, if you ask me, playbook. And some of these 3-4 sectors we are very, very sort of convinced about it. Only thing we are right now not buying or not very, this thing is, one is consumer durables or consumer discretionary, because that I think is still some time away recovery, and maybe to some extent commodities and real estate kind of players we are avoiding. But rest structural stories where there's a long runway of growth ahead of us, we are kind of right now buying and nibbling and advising same to people.
Vikas, great to have you on the show. Thank you so much for taking the time out and joining in today with your thoughts on the markets.
Thank you very much.
Let's just revisit what the market has settled in at. After a positive start, we are managing to hold on to the gains so far, at least. Of course, it's Asian Paints after that crude dip. There's L&T holding out well, Tata Steel, Hindalco. These are all names which are supporting the index today, which also is holding up about 0.5% or so. It's not a meaningful move. We couldn't quite latch on to the opening highs. We've definitely eased out from there. But still under pressure for a Bharti, for a Unilever, Techem, HCL Technologies. Reliance is absolutely flat, as are Nestle and Britannia mildly soft. But let's discuss RK Forgings. That along with TW have emerged as the lowest bidder in forged wheel project. In fact, they've managed to pip and leave behind the likes of SAIL as well as Bharat Forge. So let's try and understand what this project is going to be all about. We have Lalit Khetan joining in on the show right now. Lalit, hi, morning. Good to have you on ET now. What is the expected offtake, Lalit, from this particular order, and do you have the necessary capacity to fulfill it?
Good morning. The capacity will be set up, a new capacity for this project will be set up, and it will take around 18 to 24 months to start the production. But the offtake will be quite huge, because we are not looking only at the railway, we are looking at other markets also, and even after this Ukraine issue where the largest forging wheel facility has been destroyed, we are looking at it globally, and we will set up a huge facility to cater to the entire market.
Cost of this facility, when do you think the capacity would be streamlined?
Yeah, that will be from after 2 years from now.
And this would be funded by internal accruals?
No, it will be a mix of debt and internal accrual.
Okay. 2 years now, the capacity would be set up, which means by the time the revenue comes into your balance sheet, it could be 2027, 2028.
2026.
Okay. What are the broad return ratios expected from this facility? Are they higher than what your average return ratio is?
Certainly, what we are looking at, what we are making right now, we are looking at higher than the current profitability.
What gives you the confidence to expand capacity at a time when we know that there is a large fear largely with what's happening in China?
See, this is a sector where India is not making the forged wheel. India has lot of consumptions like Vande Bharat and all over the new development in railways, and even in aftermarket it will have lot of consumption. And globally there is a shortage of forged wheel. And with the government coming up with the 20-year of firm order, so that gives us a minimum leeway or minimum capacity utilization, guarantee capacity utilization. So that gives us the confidence. Yes, we can do big on in this, and we can grow exponentially in this forged wheel.
Look, when it comes to the export of forged wheels after having met the railway requirements?
Yes, we can export. We are certainly looking at global market of the forged wheel also.
What kind of an opportunity are you looking at in terms of, how much that would be of your total revenue pie and the kind of revenue that could potentially generate down the line?
See, we are looking to set up a plant for production of 2 lakh wheels per annum. So after the railway, whatever is there, we are looking to sell in other markets, and it can be in domestic, it can be exports, and that time will tell, but certainly market is there.
You upping your guidance, considering you're so bullish about the order inflow and what it would entail? Because I recall 5,000 crore rupees what you had guided for in terms of revenues for FY25. Would you look to change that now?
No, that guidance remains that because this will be in a consortium. So the turnover will not be added in the RKFL turnover because it's a JV, but profitability will come to RKFL.
Okay, well, really appreciate your time and thank you for joining us. I'll revisit a conversation we had with Shankar Sharma earlier in the day, and it's all about that there is no comparison, there is no parallel, and there is no iota of similarity between 2008 and 2023. What happened in 2008 was a breakdown of the system. This is a banking failure within the system. Big difference.
I think Adani was a non-issue for any serious investor in the stock markets. I mean, we made it an issue beyond what it deserved to be. It's a large group, but still one group, and one group cannot be said to be representative of the entire market, no matter which group that is. I mean, we have had governance problems with Infosys. We've had governance problems with Reliance. I mean, and not one, but I mean, I think maybe a dozen of them. SEBI has passed orders against Reliance promoters, against Mukesh Ambani or against Reliance company or group companies. Sun Pharma, marquee company, has had series of problems in the last 3-4 years' time. None of that has been represented in the public eye as if that is going to dent the image of India or it's an attack on India. I mean, that's all complete and total nonsense. This is a group problem. The group is dealing with it, and more power to them. They are important for the growth of certain parts of India, which is the infrastructure part. And I hope and I pray that they come out of it. But to extend that to say the market is going to suffer because of that is, I mean, that is a complete non sequitur in my view. Again, I say these are all, we draw false positives and false correlations and causalities. Adani Group or SBB was not the reason why the Indian markets have been somnolent in the last 2 or 3 months' time. The reasons are more internal. The reasons are that there is a slowdown in the economy based on the GDP numbers that we have seen. The markets have been sensing that. And I speak to companies all the time. And right after Diwali, from Diwali onwards last year, I started to get a sense that there was a slowdown in spending. Rural has been hurting in any case. It was urban spending which was propping it up, and that's also started to slow down. So that is where the market started to get a bit jittery about numbers, corporate growth, corporate earnings growth. It's not Adani, it's not a foreign bank contagion.
Shankar, just taking a leaf off from your latest tweet, saying that some of the yields available in fixed income and financials in the US are looking simply mouth-watering. Do you think the fact that fixed income is giving you more, better or more assured returns than equities is going to make the attractiveness of equities as an asset class, shrink in the near term?
You're 100%. I am assuming that's Aisha. Okay, wait.
Yes.
Yes, hi, sorry. The screen was minimized. Right, yes. Hi, Aisha, morning. you're absolutely spot on. I think that is the competition for the market, is the fixed income part. It's a much detested cousin because all of us are equity guys. We don't like fixed income in most part, but it is providing in India and globally some amazing, returns. I mean, in the US, like I tweeted, you can buy good quality bond ETFs for now for about 5%, 5.5%, 6% yields, even 7% yields. Real estate investment trusts are like 9%, 10%, 11%, 12% yields. In Singapore REITs, you can get, fairly decent yields. So in India, the yields are really mouth-watering, to say the least, which provide you low volatility returns for an average investor. So it is, again, that is a good reason to attribute for the equity markets underperformance in India. Adani or the foreign bank thing are all just very temporary phenomena. It's more fundamental, which is that rates are very attractive and people are at this point choosing rates over fixed income over equities. And again, I go back to my point that the economy being what it is, my belief is you're not going to get a broad bull market. I don't think any of us should hold out hope that we are going to see a broad bull market in India, that is, anytime soon. We are going to see very patchy markets in which a reasonable part of the markets will be flat or even down, while small pockets of stocks, whether in the Nifty or below the Nifty, will be doing well. And that's really the skill of your investment acumen will be tested in this year.